I think the reason why only 73% of people who buy investment property stop at 1 is because the asset doesn't perform well. So if you unroll that, it means that they've probably bought a lemon. So they've just gone and bought any particular property rather than taking a strategic view and looking at that asset as an investment grade property, as opposed to, oh, there's a new apartment being built and someone's given me a nice fluffy brochure on it and says it's a great investment. If they don't do their homework, they're destined not to get to that position. And that's really sad, because the reality is one property is not going to deliver you the passive wealth creation or the passive outcomes of income that you're looking for into the future. To me, property investing can be as simple as ABC. A standing for asset selection, B standing for borrowings, and C standing for cash flow management. So let's break those down. Asset selection. You know, the performance of that asset is going to be the difference over a 10 or 20 year period of maybe $500,000. Now, that's going to be part of your wealth base, and part of the income that's going to be derived from that property is going to be determined by the value of that asset over time. So asset selection is critical. B is for borrowing. Now, when I talk about borrowing, that is one of the key reasons you might invest in residential property. With borrowings, we're talking about magnifying and controlling a larger asset that hopefully is going to be compounding in growth and growing quicker over time. So when you're looking at investing, you usually bring borrowings into the conversation. Now that leads into C, which is again a critical element, cash flow management. We've seen what the GFC did to businesses when basically they leveraged themselves or borrowed too much money and didn't have the cash flow to sustain that. Those businesses collapsed. So the foundations that you want to build should be built on stone, and that is all about money planning and making sure you've got the suitable cash flows in reserves to meet your obligations around the borrowings, so then you can pick the right asset, and collectively they make a pretty good strategy. If someone was coming to talk to a property investment advisor, they may have done some reading around buying for capital growth versus buying for cash flow, and there's plenty of commentators in the market who are always talking one's better than the other. The reality of the situation is, look, both can be used as part of an overall investment strategy. So if I'm designing an investment strategy for clients, I might put a couple of capital growth properties in there, but then I might put the third property as a higher yielding property. So I'm balancing out and diversifying that portfolio. So the argument around capital growth versus cash flow positive properties is irrelevant to me. It's all about the end game, and it's about tailoring that solution to that particular client. And if I'm building up a series of properties over a period of time, it's about the rental income that I'm going to get. And that's what the art of retiring on property as a passive income stream is all about. At Empower Wealth, we are about educating our clients and educating anyone who's interested to learn more about investing in property. So we've got a free report on this page which you can download. If you're interested in having a free consultation, you can book an appointment with one of our professionals who can step you through and analyse your circumstances to see whether you're ready to invest in property today.